Roger Conrad, and welcome to another issue of Questions and Answers. This time around, we're in Las Vegas at the Las Vegas Money Show. So we're talking to a lot of investors there, and that's where I got the idea for this issue of Questions and Answers. 7 deadly sins investors will commit over the next 12 months, probably by the time we're back here again. So let's get started. Okay, so the first of the 7 deadly sins is confusing a share price recovery with reduced dividend risk. A lot of stocks have bounced back, particularly riskier stocks this year, and particularly in the energy industry. And so we've heard a lot of people talk about that, it's to give the all clear. Certainly a lot of our competitors are giving investors the all clear in the MLP space. We think there's still an enormous shakeout to come. There are some companies, some MLPs that are in very, very good shape here that have been really knocked down with everything else, the baby being thrown out with the bathwater, so to speak. There are others that really do deserve actually a much lower price. So we think we're going to see some dividends being cut, and it's just absolutely imperative for investors to really look in how companies are covering their distributions, how companies are, what sort of debt they have coming due, who their counterparties are, really getting a good handle on the risk. That's what we do in our publications, Energy and Income Advisor, as well as Conrad's Utility Investor. Okay, so the second deadly sin is betting on the Fed. Now, I know everybody likes to do this. Everybody that watches CNBC and reads the popular media, it's all about the Fed. And that's when you talk about dividend-paying stocks, is the Fed going to cut interest rates? Is the Fed going to raise interest rates? And of course, the conventional wisdom is you sell when the Fed is going to tighten, in other words, raise interest rates, and you buy when the Fed is going to loosen, cut interest rates. Well, I think we pointed out many, many times to our readers the examples of how that's an absolutely horrible strategy. Let's go back to the last Fed tightening cycle. That was from June 2004 to June 2006. The Fed funds rate went from 1 to 5.25% over that time. It was a great time to own utility stocks. One of the best 2-year periods ever. The Dow Jones Utility Average returned over 60%. That was 4 times what the S&P 500 threw off over that time. So, again, people try to follow the Fed. They try to second guess what the Fed's going to do. You're best off focusing on the stocks. You're best off trying to buy good companies at good prices. Okay, the third of the deadly sins is over-reliance on exchange-traded funds, or ETFs. Now, ETFs have given investors a really handy way of investing in different sectors, of investing in different markets, and we really use them a lot, particularly in our trading products. But they really do make a very poor substitute for buying individual stocks. And I think the real tragedy is that a lot of people don't even know what's inside of those ETFs. So, for example, the Alerian MLP ETF, the ones that are based off that index, Enterprise Products Partners, a company we actually like, is about 20% of that ETF. So that's not necessarily a bad thing, but I bet it's something that not a lot of people know about that ETF. And what happens when people sell these ETFs is that it amounts to a giant program trade. A lot of stocks get knocked down. A lot of investors get hurt in those ETFs. So don't rely on those ETFs. They are good for some things, like I said, particularly trading and trying to get access to a market that may be more difficult to get access to. But they're a remarkably poor substitute for just picking out the best stocks in the groups that we like. And certainly in Conrad's Utility Investor, we have a number of those in the utility space. All right, the fourth deadly sin that investors are going to commit this year is not selling to high grade or cut risk in their portfolio. We're in the 8th year of a bull market right now. Valuations are up quite a bit. The bad stocks have been carried up with the good. ETFs are responsible for a lot of that because, again, when somebody buys or sells an ETF, they buy and sell the good, bad, and ugly of that sector. So a lot of volatility, a lot of stocks have been pushed up. This is a great opportunity to get rid of the dogs in your portfolio. I know a lot of people have a problem anytime they're in the red in any sort of way with a stock. But think about it this way. A stock or company that has a bad business that isn't going to hold up in a bear market, that isn't going to hold up, say if we get a recession, you want to get rid of that because it's going to lose a lot more money. That little loss that you're looking at now taking is going to get a lot bigger, chances are, over the next 12 to 18 months. And we've seen that again and again and again, even as this bull market's gone on. When a company has really hit bad times and, say, cut its dividend, odds are it's going to cut again. So sell it, take that loss, high grade, get into something good that's going to do a lot better for you going forward. Okay, so deadly sin number 5 is not selling to take windfall gains. Most of us aren't really used to thinking of utilities or dividend-paying stocks as investments that we can take windfall gains in. We usually think about them as something we're going to hold for a long period of time, collect the dividends. Nothing wrong with that. In fact, I practice that in my own personal portfolio. But one thing that is true, particularly in the latter stages of a bull market, is you see companies that are really, really good companies that are going to make it through bad times, but get bid to really high valuations that they're just not going to hold. So what winds up happening is people ride these things up, they watch them come down, they're actually tempted maybe to even sell as the price comes back down. But all that's really happened is that excessive valuation has been squeezed. So one way you can get around that and actually put a little money in your pocket for what I think will be a lot of bear market opportunities coming up is just to take a little money off the table from some of those companies that have really appreciated quite a bit in your portfolio that are not going to hold those high prices. And maybe you can figure it out this way. What's the price you would pay for it? What's the current price of it? What's the difference between those prices? How many quarters of dividends does that represent? Because when that premium is squashed and goes away, that's how many quarters of dividends it's going to take for you to make that up. So don't be afraid to take a little bit off the table. Don't worry about taking it all off. Focus by all means on the best companies, but take a profit when it's proffered. All right, so deadly investment sin number 6 is ignoring dividend growth for yield. I think a lot of investors are basically yield seekers. And when we see a 10% yield or a 12% yield, if we've been around these kinds of stocks, we're tempted. We want to jump in. And maybe we take a look at a company that's growing its dividend 5% a year and turn our nose up at it. I know this happened a lot during the bull market. I think now people are maybe a little bit more focusing on safety. But what I think a lot of people don't recognize is the fact that a company that is yielding, say, 5%, growing that dividend 5% a year reliably, is going to do much better over the long term for you in terms of building wealth and even in terms of income than something yielding even 10%. That 10% yield is telling you right there, it's a red flag that this is a potential dividend cut. So that dividend gets cut in half, you lose all that cash, but the stock is also going to come down. Conversely, though, a company that's raising its dividend, its stock price is going to rise behind that dividend going up. So you get capital gains, you get a rising stream of income, and you get a pretty generous dividend off the top. So again, this is where investors need to focus. I know a lot of investors won't be focused there. I've talked to a number of them already here at the Money Show, and that's not where their heads are, but don't be one of them. Again, the low, slow, and reliable growth, I think, is going to really pay off for investors going into what's likely to be a bear market sometime in the next 12 to 18 months. All right, and last but not least, investment sin number 7 is sticking solely to US dollar investments. The US dollar has pretty much blown every other currency out of the water over the last 5 years. And if you go back to 5 years ago, what people were talking about at that time, gold was almost $2,000. People were talking about states issuing their own currencies and so forth. Well, that's pretty much typical talk when a currency is about to turn. This time around, conversely, we're starting to hear the other type of talk. In other words, that the U.S. dollar is just too strong, other currencies are too weak. I think you really do yourself a disservice if you don't try to shop outside the United States for companies. First of all, a lot of the best companies, a lot of the best opportunities are outside the United States. There's a lot of nice yields, a lot of nice growing dividends out there. But also, in a balanced portfolio, having exposure to other currencies, because when that currency goes up against the U.S. dollar, your stock benefits all the more. Your dividend the U.S. dollar value of your dividends goes up. So there's a lot of very strong positives there. And again, it feels like the sentiment very bad for foreign currencies. Expectations are low. a lot of opportunity there for that. So don't keep it all within the U.S. There's a lot of opportunity abroad, and we cover it in Conrad's Utility Investor as well as Energy and Income Advisor. So thanks everyone for tuning in. These 7 deadly investment sins, I hope you'll avoid all of them in the next 12 months when we'll be back here, I guess, at the Las Vegas Money Show once again. So thanks for tuning in, and the best of goodbyes.